Well, good morning, folks. How are you? Just going to test myself here and wait for my feedback here. Also get a okay, so it's about 7 or 8 seconds delay. All right, just give me a few seconds. Work out my my settings here. The audio should be loud enough. Should be coming through. It's coming through my headphones pretty good. So, all right, for everyone that has real time, you should have real time if you're watching this. That way you'll know that what I'm about to show you is all real time. It's not delayed data or anything like that. And thank you all for showing up. So I want to have a little discussion with you today. And there'll be buttons pushed in front of you in case you guys want to know that. But the important thing first is that, as you can see here in the lower left-hand corner, that says paper trading. Okay, let me clear the air real quick. I am not licensed to give trade advice. Okay, so what I'm going to be discussing today is my opinion, it is my belief why price does what it does. Okay, and because I'm talking over a medium that can be used for gambling, it can be used for risk taking, and money can be made and lost based on the actions, whether directly or indirectly, based on my opinions. I'm reminding you that what you see me do today and what you see me talk about is being done in a paper trading account for my legal protection because I'm not licensed to give trade advice. None of the things I'm going to discuss today are going to be considered a investment idea for you to go out and risk real money. Okay, so that way we understand each other. In the United States, they take it very, very serious. I'm not trying to entice you to buy or sell any instrument, any investment idea, nothing. Not crypto, not futures, not commodities, not Forex. Okay? So, today, I kind of want to open up with a casual suggestion. Say you and I never met before, okay? And say we were in a coffee shop and you happen to see me with a laptop and I'm sitting there looking at charts like this and you've never seen it before. And you watch me and you're intrigued enough to come over and ask me, what is it that you're doing? What is it you're looking at? Now, being who I am by nature, I'm always interested in sharing and trying to get people to look at things like this because it's been my entire life. But invariably, the same questions that I've always been encountered with is, what is it you're doing? How do you know that it's going to do a move higher or lower? How do I trust things? How do I know when to buy or sell? All those types of things would come up all the time, every single conversation. And if you saw all the comments that come to me in my YouTube channel, yes, I see all of your comments. But there's a setting on YouTube that allows me to keep them approval only. In other words, I can review all comments because there's a lot of crypto people trying to get people to buy and sell crypto. There are websites being offered that are not something I would support. So to keep from babysitting all that stuff, I just set it as review. And I don't ever really approve any message, but 99% of them and more, they're all very appreciative. But the questions that come up a lot are, how do I know? How do I know where to place my stop loss? And how do I know where to buy? How do I know that that fair value gap is going to be the one that is going to support price? How do I know that that high is going to be ran out? How do I know that it's not going to just run that high and keep on going? So I kind of want to teach a little bit today, and I want to be relaxed about it. So I want you to just sit back and just relax. Try not to have all of these preconceived notions, even if you don't really like me. I promise what I'm going to show you today, it's going to help you if you allow it to. Okay? So when we're looking at price, if you don't know what you're looking for, if you don't have a model, if you don't have a understanding about what it is that you're seeking in terms of price action, what constitutes a high probability setup? Because everybody really, if we're going to be honest with one another, you really want to only pick the winning trades. Okay, that's really what you're asking for. And these are the same questions that I wanted answers to when I first started, especially when I started prematurely. In 1992, I put money into an account before I was ready to start trading. And I lost 50% of it on my very first trade, and I was trading options, and I had no idea what I was doing. So that was a baptism for me, and it left a very deep scar. So I had a great deal of respect for the measure of risk, but I also realized that someone on the other side of that made money. So it was my pursuit to try to figure out how I could get as close as I could to perfection. Now, admittedly, perfection in trading is not obtainable, okay? And you have seen me do things with trades, with accounts, all these things, and I've called things on Twitter live minute by minute. And you're going to get a taste of that here visually, okay? So we're going to be here for about 3 hours together, and I want you to think about all the questions that you have bundled up that has caused you anxiety and or has caused you to go out and start buying funded account challenges, or maybe you went out and put your real money into an account prematurely like I did in 1992, thinking that I would just get lucky, and that luck, that payout, that profit would inspire me to keep doing it and be more diligent about learning. And that's the worst thing you can do in trading. So I want to kind of like attack certain generic principles that I think that if you start like this and you strip away all of these expectations you're placing on yourself that are too lofty right now, especially if you're brand new or if you've never been consistent with trading, this is how you dismiss all those things that are pushing you by fear and greed and anxiety inducing. You strip it down to what is price doing right now. Okay, you're not trying to determine the highest high of the day. You're not trying to determine the lowest low of the day. You're not trying to find the entirety of the move for that particular day or that trading session. Strip it down to what is price doing right now. And it matters not how many points, handles, pips, nothing. I'm only going to be talking about the NASDAQ today. But everything I'm going to discuss is pertinent to what I would believe about a Forex pair, a commodity, a stock, a bond, and I don't trade crypto. I'm not trying to go so far to say that here I'm going to co-sign and say it's going to work there. But I have students that use my concepts and they subscribe to the idea that it works for them. Okay, so I can only tell you that, but I don't have anything in terms of personal experience with trading crypto at all. Okay, so I want to kind of like build the foundation on what it is that you should be looking for if you're trying to learn how to read price action. You see the examples I show when I'm executing, and I show the visibility. And I was listening to a video that was sent to me by Al Brooks. Okay, there's a lot of people saying that I learned from Al Brooks or I trade like Al Brooks. I would love to see Al Brooks trade. I would love to see him do executions. And I don't mean that to be disrespectful, but the idea of reading price one candlestick at a time, I didn't get that idea from Al Brooks. In fact, I really never looked at Al Brooks until I had a conversation with Tom Hugard, and he mentioned that he was a great influence on him. And in conversations I've had with Tom, I was like, let me see, because I've had people saying that I learned or I trade like this guy Al Brooks, and his video, one of the video portions I saw, he said that it's impossible for anyone to make money or make a living off of scalping. And I'm going to dismiss that today. Okay, I'm literally going to smash that on the rocks and let you know that that is a lie. You can absolutely make a living out of scalping. Okay, I think that even if you are not inclined to be a day trader, I think that you should trade with lower time frames in a simulated account like this, because it'll give you a great deal of experience. It will teach you how to read and anticipate price action. And let me go back for a second because I want to make sure that nobody takes that sound clip and take it out of context. I have nothing against Al Brooks. As far as I know, he's never said anything about me. I'm not even sure if he even knows who I am. But I'm only attacking the opinion that he shared, okay? Because if I subscribe to views by other people in the community before I learned how to trade, I would allow them to influence me negatively. So I'm trying to dismiss everything that would be a hindrance for you. And there's a lot of people out there that'll say the same thing about me. But I want you to think about what I'm going to show you today. So the beginning point is this. What are you intending to trade right now? You have to determine whatever that is. It needs to be one thing, not 5 things, not 2 things, not 3, not the entire board of the FX pairs, not every index, not Dow, not NASDAQ, not S&P, all of them together. Okay, it's one. Because if you can focus on one market in the beginning for months, and some of you want this fast track learning, get me into making money because I want to go out there and get a funded account passed and start getting withdrawals. I promise you, if you try that, you're gonna fail. In that early stage of hindrance or holding you back, that's going to be detrimental to you wanting to continue. And it's going to be easy for you to reach for that as an excuse to quit, and why bother? Okay, so I'm only putting this small piece of preamble in the beginning because I want the setting and the mindset going into our discussion and where I'm actually going to be pushing buttons in front of you today. So you're going to hear all these people that you'll never see. You're seeing everything today, everything. But I want to remind you where I have my cursor. It's on a paper trading account because I don't want to be acting as a influencer that is going to cause you to buy or sell. Please do not copy anything I'm going to do today. I promise you, you will regret it. You will regret it. Whether it works in your favor or not, you will regret it because it's going to input into you a tethering that I try not to have with my students. All my students that are profitable, they make their trades on their own. I never tell them what's going to happen. And I don't trade most of the markets they trade in. And they have proven that they make money with these concepts. But I'm targeting the individuals that want to improve their tape reading. And you don't need a ladder, a depth of market. You don't need Bookmap. You don't need any of those things. Okay. But if you want to work with those in concert with what I'm going to show you today, you're going to see that we see liquidity before those things even draw any attention to it. I promise you, you don't need any of those gimmicks. Nothing. You have nothing that you need except for these bar charts or candlestick charts that are in front of us. That's it. And a clock. That's all you need. All right. So now, back to the setting. I'm in a coffee shop. You come up to me. What are you doing, guy? I'm looking at the NASDAQ and I'm looking for an opportunity to buy or sell to make money. And the person would obviously ask questions like this. Well, how do you make money doing that? Skipping all over those questions and going right to the point. How do I know when it's going to move up or down? Because when you first look at these charts, and you probably know what it was when you first looked at them, it's like, what do you do with this? Like, how am I supposed to determine what it's supposed to do? I'm going to show you what it is that I'm going to teach today. I'm going to recap what I did then, and then we're going to watch the market live, every single candlestick. And I'm going to annotate audibly. I'm going to draw attention to things that I believe are going to be influential for price action. And we're going to watch and see if price does, in fact, find some support behind those ideas. And does it run to the areas that my interest is lying in? Okay? Because this is the beginning point for you to learn how to trade. You cannot learn how to trade from my books that are going to come out. You're not going to learn how to trade from my videos. You're not going to learn from anybody else. You're going to learn by you doing the things that are suggested by people that know what they're doing. So I want to take you back to this little area right here. And I really wish there was a way for me to highlight my cursor. So I'm going to move very, very slowly so that way you can track it. The largest chart we're looking at here is a 1-minute chart. Okay. And the lower left-hand chart here is a 5-minute chart. And the upper left-hand corner is a 15-minute time frame. When you're trading, it's important for you to have not just one single time frame. You're going to execute on one time frame. You're going to have all of your analysis built on a higher time frame chart. That would be, in this case, if we're going to be scalping, because I'm attacking the idea that you can't make money scalping. You absolutely can eviscerate the majority of what everybody else thinks is a good return. You can literally do that every single day. Scalping, you can do every single day. There isn't a day that you cannot go into the marketplace and not make money trading as a scalper. You absolutely can do that. The problem is you're going to go in and try to do it more time than is necessary for you. If you go in and you made $2,000, you're going to feel really good about that. And it's going to feel like, wow, I want to spin the wheel again. I want to throw the dice once more and get that feeling again. And that's what you have to fight as a trader. You have to fight that urge to do that. And as a scalper, you can go in there and go insane, make lots of money, have a long series of winning trades, and then do something stupid, regret doing that, try to get it back, and it turns into blowing your account, going into severe drawdown. You've seen YouTubers do this. You've seen influencers come out and be honest and say this is what they're plagued with. And I'm trying to help you if you listen. But you have to have multiple time frames that you're going to be referring to. I'm going to drop down below a 1 minute chart too to show you the significance of what price is doing on these lower time frames, sub 1 minute. Every single hour, there's an opportunity for you to scalp. Every single 15-minute interval, there's an opportunity for you to scalp. Now, the problem is, and I found this out to be true for myself when I first tried to do scalping in the bond market in the 90s, I could see these moves on the very small time frames, and then I would get married to the idea it was going to give me more than what I subscribed to or framed for my trade. And what do I mean by that? Let's assume for a moment that we were looking at these lows down here on the 1 minute chart. Okay. And let's assume that we were considering how the market is recently trading at all-time highs. And I'm going to address that here because it's also a question that keeps coming up a lot still, even though I answered it in my comment community section on my YouTube. When a market trades into all-time highs, I am completely in the same category as every other trader. I don't know what it's going to do. I don't know how far it's going to go higher. You don't know how far it's going to go higher. You don't know when it's going to stop. You don't know if it's going to reverse. No one knows that, folks. No one knows that. So it's a very interesting condition to be in as a trader because I know lots of things in how to trade inside of a range, outside of a range, but at all-time highs, I have no tools. I have no tools. I have a blank canvas in front of me, and I have to wait for the paint to be applied to the chart. I gotta work with what it gives me. And in my mind, this is the way I interpret it. Since we traded to all-time highs, I don't want to go against that. So I will look to take buy signals until those buy signals prove to me, not just by one losing trade, not by two losing trades, but if I go through a series of several days in a row, and if I'm buying and it's failing and I'm going in drawdown, and yes, I can go into drawdown. This is exactly where I would incur it because I'm in a discovery, just like you are, of whether or not the market is going to allow for prices to go higher. I believe that it will. It's a presidential year. It's election year. They like to pump the markets up going into that. And every person that's been calling for a market crash has been made a fool. And I'm not trying to fight against this. So I'm willing to keep applying my bias as being bullish, looking for buy signals until I start seeing them fail. Okay. Now, the logic I just gave you, there's nothing else outside of that I'm hiding from you. It's honesty, it's transparency. I don't know how far it's going to go up. And I don't know if it's going to reverse today, tomorrow. I don't know. I have to wait and see. I have to be responsive to that because we're in an expanding unknown range. We have no idea where that terminus would be. So because it's more likely to keep going higher, I want to focus primarily on being a buyer only. Not that I won't go short, but I need to know that the larger, higher time frame momentum and narrative is it's probably going to keep being pushed higher, keep quoting it higher, booking it higher, repricing it higher. So because that's the underlying premise, I don't want to put more emphasis on selling short thinking I want to catch the high because that's really what you're trying to do. And I try to do a lot of that in the 90s. I tried to be the highest high and the lowest low, that type of thing. And there's ways of doing that stuff, but not in this condition. You never want to try to pick the top in a market like this. It'll rip your face off. So with this in mind, apply that same logic of, okay, if you subscribe to the idea that a higher time frame weekly or a monthly or daily chart is suggesting prices are going to be bullish, you want to limit your focus to being a buyer. That does not mean that you can't find scalps that go short on, but if you don't know what you're doing, or if you're lacking consistency, or you really can't read price all that well, start with just having a higher time bias and only study price action without pushing the button, with that in mind. Now, with that premise, we can see that we are in 7 o'clock in the morning. So 7 o'clock is the New York kill zone. So at 7 o'clock in the morning, I can start looking for setups in any market. And I said this before, but it goes over the heads of some of you because you're not really doing too well in terms of taking notes. There are things that I'll talk about that are specific to Forex, and there are things that I say that are specific to futures. And unless I say that at the time of me teaching it, everything I say is universal. That's my belief, okay? So at 7 o'clock in the morning, that starts the New York kill zone. So if we have that delineated, sometime after 7 o'clock, I'm bullish. Why? Because we traded all-time highs. I don't want to try to pick the top. I don't want to be a sucker and try to, do something that's impossible. So I want to look for areas where the retail trader that wants to sell short or try to pick the top, or aggressive traders that think they're going to outsmart the marketplace, they're going to buy early. And by buying early, they'll place a stop loss below a low that forms just after 7 o'clock in the morning. So here's 7 o'clock. We have a low. We went lower here, but see how shallow that was? You see that? Does that imply a continuation the rest of the day? Probably not. And as we get closer to 8:30, 8:30 is usually a turning point, because whether there's news or not, and there really isn't any news of any significance until 10 o'clock today. Some kind of manufacturing index number or something. And we'll get to that when we get into 9:30 going into 10 o'clock with the opening range. But this low here, this run here, it runs to this high to take out the liquidity. This low takes out the liquidity below here and here. See that? So what I was looking at, and I promise you, I'm going to push the button live in front of you, but I'm going to teach this part too, because this is literally what I'm going to do to win the Robbins Cup in 2024. I'm telling you in advance exactly how I'm going to do it. And you'll see in my statements, this is exactly what I was doing. Nobody's ever done this before, okay? I'm telling you, I'm that confident that this is what it does every single day. It does this every single day, and it's not going to stop. There's going to be times that I'll read it wrong, but this is what's going on every single day. The market will trade to liquidity for the purposes of stopping out people that would be profitable at a later time when the market does run. So what is our bias today? It's a bullish bias. We're not trying to pick the top on the daily chart. So we're focusing primarily on being long. When do we start looking at the charts? At 7 o'clock in the morning, it starts the New York session. Do you need to be in front of the charts at 7 o'clock? No. Can you start at 8:15 and wait for 8:30? Yes, that's a good time too. You're not locked into that, because I just told you at the beginning that every single hour you can scalp. Every single 15 minute, there's a scalp. Every quarter part of 1 hour, there's a scalp. But it isn't going to run 100 handles all the time. So you have to strip it down. So what's the minimum that I would like to see for trading and scalping the NASDAQ? It's 10 handles. If I can't at least make 10 handles, and I'm going to tell you how to determine that, okay? But if I can't make at least 10 handles, I'm not willing to take the trade. I don't care. I'll let it go. And there's lots of setups that I see all day long intraday, if I'm in front of the charts, that I will say, okay, I think it's going to do this, but I don't want that one. And I'm going to tell you how to determine that today. This is one of those lessons where you have to let me talk, but I promise you're going to see it. because I'm going to show it to you in charts real time. But if we don't have an expectation of what we're focusing on going in, we're wasting our time here today. And I can push buttons in front of you and make all kinds of pseudo profits, and you'll leave knowing nothing. And that's not why I'm here. I could keep going back and making videos of me doing executions and showing you that way. And that's fascinating. It gives you study homework. But I'm here to teach you today. So if we look at how the market dropped down and it took out these lows here, see how they're relatively equal? See right there? I'm going to take this vertical line off because it's a little too aggressive. When we see that low right here on the 5-minute chart, see it right here, right above my cursor? That is this low right there. Okay. Go to the left of that low. What do you see? That's a down close candle. That is an order block. Friends and neighbors, that's not a supply and demand zone. Okay? It's not. What this is a candle that is opposed. It's closing lower. So it's a down close in a market that's predisposed to go higher. Why should it go higher? Well, go up one time frame from the 5-minute, and it's the 15-minute. What's right here? See these smooth highs right here? I'm going to annotate that. There. Okay? So you see this high right there? Look where it goes to. It goes right there, stops, and comes right back down. And does what? It unsettles the longs that had a stop loss right below that low right there. And then the more prominent run takes place. And it's reaching up into this high. So on a 15-minute time frame, whether I'm scalping, whether I'm day trading for the full daily range, or if I'm short-term trading, regardless of whatever I'm doing, I am always referring to the 15-minute time frame as my bellwether time frame. Because on a 15-minute time frame, let me maximize this real quick here. On the 15-minute time frame, this is going to give me all of the salient points of liquidity that I believe is going to be pertinent to the session that I'm going to trade or about to trade. And it also will have the built-in advantage of showing me the daily levels that I'd be interested in if I'm going to trade the full daily range. If I want to get the lines portion of that full daily range, whether it be an up day or a down day, I can determine those points of liquidity, whether it be buy side or buy stops, or sell side or sell stops. I can clearly and easily see them on the 15-minute time frame. And I can also see all of the pertinent imbalances, whether it be a sell side imbalance, buy side inefficiency, or buy side imbalance, sell side inefficiency, meaning a fair value gap with an up or down close. And right now, when we see price here, afford me the ability to talk about this because I did an execution before we started, and I'm going to walk you through that. That's what I'm doing here. And then I'm going to do another one after I go through that. And then at 10 o'clock, I'm going to do another one live right in front of you. I'm going to put the trade on. I'm going to put the stop loss on. I'm going to talk about every single candlestick that I believe is going to paint after that. But allow me, okay? Allow me the floor to do it like this, okay? If we see this setting here on the 15-minute time frame. Now think, we start the day at midnight, New York local time. That's the beginning of the new day. What does the London session do between 2 o'clock and 5 o'clock in the morning? Folks, I would have paid money for someone to teach me what I'm going to show you today. And you're getting it for free. That's worth a thumbs up. All right, between 2 o'clock and 5 o'clock in the morning, that is the London Open Kill Zone. Why is that thing taking forever to make a box? There you go. So from 2 o'clock to 5 o'clock in the morning, what's the market do? It drops. This here is a Judas swing. A Judas swing is a fake price run for the express purposes of taking traders out of potentially profitable traders, position being long in this case, or to put them into the opposite direction, because there's always going to be traders out there that trade a breakout. I'm not a breakout trader. We'll talk about breakaway gaps today too, by the way. The idea of focusing on a bias that is bullish. On the daily chart, weekly chart, and monthly chart, we're expecting higher prices. We're not resisting the likelihood of higher prices and a new all-time high on NASDAQ. So because of that, in my mind, I want to see what price does between midnight going down into 2 o'clock. Is price dropping? Yes. Is it dropping to some random level? No. Look over here. Below that low is going to be what? Sell stops. So traders that see this low and break below that and it's consolidating, someone's going long there. I don't need to know who it is. There's always going to be buyers and sellers, always. But that buyer or seller pressure is not what causes the markets to go higher or lower. The markets are absolutely rigged. They're engineered to go higher or lower because whatever the market is in fact trying to reach for, buyers or sellers, they're not pushing it there. The market's going to go to where the liquidity is, and it will keep repricing until it gets there because it's a game that's controlled by them, quote unquote. Okay. If you understand that and just warm up to the idea that it's rigged, initially it sucks when you think about it because you think, well, I have no chance. But when you realize it is rigged, now you do have a chance because it's rigged. It's not random then, right? So if we're bullish and we see that they did in fact take out traders that had stops below here at a time of day when it creates the high or low of the day, not all the time, not all the time, most time, between 2 o'clock and 5 o'clock in the morning, London will create the high or low of the day, whether it be Forex, whether it be index futures, it doesn't matter. This is a truism. Do not take my word for that. Go into your charts and study it. Now, because it does that very thing here, right at 3:30, and that's an interesting time because if you go through my private mentorship core content lessons right on this YouTube channel for free, you'll hear me even teach about that right there. And that's the low of the day. Now, when it creates that low, we want to see some kind of displacement to the upside. Because if it does do that, that's indicating the algorithm is flashing like a billboard sign to smart money who trades on it. It's going to go up now. So focus on seeking a premium price. So what is a premium price? It's going to be a short-term high because right above short-term highs is going to be what? Buy stops. And or a fair value gap above market price. Okay, so if we went down here, where is there a old high and where is there an imbalance? Well, between this low here to this candle here, what is that? That's an imbalance. It's a sell side imbalance, buy side inefficiency. A fair value gap that has a down close is a SIBI, sell side imbalance, meaning it moved predominantly more to the downside, and it's inefficient in its buy side delivery, meaning since it's one big candle that went down and closed lower, you want to find the previous candle to it and the candle after it. Those are the range extremes that you're annotating. So down here when it hit the stops, first thing in my mind is, okay, how do we trade after that? And it should go into this gap here, which is being shaded. Does it do that? Absolutely it does. Then it creates what? Another gap here. This is a buy side imbalance, sell side inefficiency, because it's a fair value gap that has an up close. So while I'm looking at price action in response to this area here, I'm also now measuring the willingness to see price find more support in this fair value gap. So I'm looking at it like a rock climber would, okay? I look at this entire drop here as a rock or cliff on a rock. And I want to climb all that. I might not be successful making it all the way up to the high or to the zenith of it, okay, the top of it. I might not be equipped to be able to get there, but I might be able to climb up high enough and get the memory or the visuals, or maybe a picture of being at that point. Well, in that case, it's here, which is what I mentioned earlier when we were looking at price action on the 1 minute chart. But when price starts to run up in here, it goes into this area here and just comes into the high of that candle right there. So what's above that? Another gap. We'll get to that in a minute, okay? But the market rallies up and it leaves this imbalance. Okay, I'm going to move this box over a little bit by 1 so that way we can see. And I'm going to zoom in also. I promise you, folks, this is exactly what's missing from you watching price action live. When you start looking at it like this, I promise everything will start clicking. And it'll feel like it's illegal for you to know what you do. So this buy side imbalance, sell side inefficiency, I'm annotating the high of that candle and the low of that candle. And I'm focusing on the range between those 2 price points on this candle here. So when you see me putting rectangles on my chart, that's not a supply and demand zone. I'm looking at how this offered buy side imbalance. It's inefficient in the scope that it is not offered enough opportunity for people to sell. It's moved one-sidedly on this time frame, the 15-minute time frame. So I'm anticipating price to want to do what? Offer price on the downside, or offer it through sell side delivery. This is buy side delivery when price is expanding higher. This is sell side delivery when it's offering price as price is dropping. Since I've seen it price drop down here, and I'm bullish longer term, I anticipate this as a stop run. I don't need to buy down here. I don't need to. I don't need to be awake. In fact, I wasn't to see this. If I was awake at the time, I would have went long in here. And then I would have pyramided in here and added more. And then I would have pyramided right there where you're going to see where I entered. This is the only trade I took today so far with this paper trading account. This right here, we're going to get into that in a minute. I'm going to go back to this for a second. So think about it. It goes down here to take the stops on a day when we're bullish. Okay, wonderful. Does the market immediately react by going higher after it goes below that low? Yes, it does. And also notice where the bodies are. See, the wicks they're trading down and past that low. That's the damage. The bodies are telling you, it's like if you were at a card game, okay, and you had a confederate working with you, someone that's going to cheat the game with you, and you're trying to beat the players at that other side of the table with you, and nobody knows that you're in cahoots with the guy across the table or the dealer. They may flash their cards, okay, and tell you, this is what I'm playing with. Well, that's the equivalent of what's going on here with these bodies. You see where the close of this candle is here? Yes, this candle went all the way down there, but then closed right there. And then this candle opened, went all the way down here, past that low again, and then closed right there. And then we opened on this candle and tore off. That to me, listen folks, listen. This is where you're supposed to be writing things down. If not, at least put down the time marker. Just hover over top of the little window down here. It tells you what minute marker this is. And write this down, okay? How do I know when to trust a fair value gap? Well, first I have to have a bias. Okay, am I bullish or bearish? Because the narrative is going to build the idea of whether or not I'm going to be bullish or bearish. The bias cannot be derived until you at least confer with what the present narrative is. And the narrative is what I've been talking about. The market is long-term bullish. We're at all-time highs. Avoid trying to pick a top. Now, take that part out of the equation, okay, because we're not always going to be trading at all-time highs. Okay, just take that away. If we're bullish on the weekly chart, you think the weekly chart's going to go higher. It's the same thing, folks. We're not reinventing anything. I'm not complicating anything. This is my approach to teaching you how to trade using my concepts inside of a live stream for 3 hours. I promise you, you're going to leave today knowing how to do this stuff. You may not fully understand it at the time in first viewing, but you will have everything in your hands. You don't need to buy my books. You don't even have to come back to my YouTube channel after this. Okay? I'm literally putting it in your hands. If my son or daughter said, ICT Daddy, can you please tell me how to do this as short as you possibly can and go right in and start making money? This is it today. This is it. Okay? But none of you are really going to consider that because you don't want to hear me talk. But the body's respecting the fact that it didn't close below that low. That tells me that this was a stop rate. So what does that really answer? Well, it answers, how do you know it's going to not go through that low and keep on going? I don't know in the first candle. I want to wait and see when it closes. It closes here. Then I want to see the next candle. What does it do? Does a little movement below that, but then the body stops there. What is that? That candle's closed right there. What is that? That's a swing low. Go back and look at the videos. That's a swing low. At a time when I'm bullish, at a time of the day when it creates the low of the day, if I'm bullish, it's knocked out traders that are long that had sell stops below that. So we crossed all boxes off that this is a high probability reversal in a day that's likely to go higher. You see how all these things come together like a dovetail. It's beautiful. It's perfect symmetry. If you wake up at 8 o'clock in the morning, 7 o'clock in the morning, anytime before the opening bell at 9:30, I look at the overnight session and see what it did like this. I look at London's trading from midnight to the London Open. And my London Open kill zone is 2 o'clock in the morning to 5 o'clock in the morning, New York local time. I don't care where you live, where you are geographically. If your charts are not set to this right here, you cannot learn properly from me because you're going to try to apply your local time wherever that is, and it's going to mess up everything. And plus, you're going to be trying to send me messages through TradingView or leave me comments in my videos saying, I'm looking at this candle at that time, and your time is your local time, not the time I'm referring to it or relative to New York time. Everything algorithmic runs on New York time. I don't care what anybody tells you. That's what it does. That's what it does. Okay? So back to this. How do you trust fair value gaps are good for longs or shorts? Or in this case, we're bullish. And we do see the signature that we did run stops, and this candlestick closes above the low that was taken out for stops. So that right there is my first indication that that's a very high probability reversal point. But I don't need to buy it yet. I don't need to buy it yet. You don't need to buy it yet. Ego says you need to buy it there. You don't. You wait for the next candle. Does it create a swing low? Yes. What is a swing low? A swing low is a candlestick that has a low right here, right above my cursor. And then the low that takes out that liquidity below that low over here. So we have a lower low in that candlestick. And then the next candle, when it closes, has a higher low than this candle here. So what we're saying is a swing low, if you'll allow me to draw a real quick, crude depiction of it. Don't worry about the colors because that's not significant here. But a swing low is this. It's any swing point in price. When the price swings up and it makes some kind of a turning point and starts to move lower, the opposite would be seen here like this. Come on. That's a swing high. A swing low is that. Okay, it's 3 bars, 3 candlesticks. And the length of these, okay, this has no bearing on anything. It could look like that, or it could look like this. You just need to have 3 of them, okay? That's also part of Power 3. It'll be in the book, trust me. Oh, you're a tease, ICT. Well, I got to do it somehow, right? I got to get y'all worked up. And a swing high could look like this, where the first high of the 3 bar candles is lower than the highest one and still lower than the third candle's high. Or it could look like this. As long as there's 3 candles with a candle to the left with a lower high and a candle to the right with a lower high than the highest one, that's a swing high. It doesn't matter if this high is higher or lower than this high. It doesn't matter. You just need 3 of them to cause a turning point. So when I see that in price action, it gives me confidence to trust that was a rate on sell side below that low here. And then the highest probability trade is to wait to see if there's displacement. That means I'm letting it, or let me properly phrase this. If I had been awake, I would have allowed for this move to occur and then tried to buy something down here. But let's say I didn't get it. Say I missed it, or I walked away from my computer and I missed the ideal entry. Then I'm going to wait. I'm going to wait for this right here. I want to see it dig up into this. And this is going to be very hard for me to have this on the chart because there's a lot of stuff going on right now. Remember, this is the sell side imbalance, buy side inefficiency between that candle's low and that candle's high. Let me take this off for a second. I want to see it run up into these extremes from here to here. I want to see how it trades there. Does it trade all the way up to and close above halfway? Halfway of what? This gap. So if we take the fib and measure that, here's 50% of it. Does it close above that? Yes. So what does that tell me algorithmically? That it's going to use this imbalance here, okay? It's going to use that as a draw on liquidity. And now I want to see it do what? Work its way back down into this gap from this candle's high and that candle's low. This gap right here, I'm only going to refer to it in terms of its consequent encroachment, which is the midpoint of that gap, the 50%. And I would use that on a lower time frame chart to see if it's going to offer me an opportunity to go long. But it's already fulfilled its role here by drawing price up. So what does it tell me at that point? It tells me that, okay, this was a stop hunt. The market does what at that point? It's going to seek inefficiencies above price. Well, it did that quickly here. Where's there other inefficiencies? Right in here. And where are the buy stops? Above that high. And it's relative equal highs, rather. So there's buy side above the market right there. So those buy stops, once these sell stops have been taken, smart money does this. It buys sell stops and sells to buy stops. You see what it did here? It went below that low, accumulated long positions with willing bodied sellers at a low price. Why? Because somebody went long here. Do I need to know how many and who it was? No. You don't either. You don't need a book map. You don't need a ladder. You don't need depth of market. You don't need all these things people say, oh, you're tape reading. Show me what you're doing with level 2 data. You don't need any of that stuff. I know what these markets are doing. I'm teaching you how to do it without any gimmicks, nothing. You have nothing to add to these charts. You just need to know what time it is. And they can't hide it. They cannot hide the liquidity that will be above here. They cannot hide the inefficiencies that the chart will absolutely draw attention to. You have to have a time-based chart. Anyone that tells you that time-based charts are useless, they're ignorant. They're ignorant. They have no idea what they're talking about because price moves on the basis of time first. It's time and price. Look at the low of the day. Go back and look at the day trading concepts and the concepts I talk about. 330, that's your turning point. It's the low of the day. You can't fight this, okay? You can punch in the air all you want, but it doesn't change it. So it's better for you to say, okay, well, the guy's not selling it to me. He's giving it to me for free. Let me investigate it further and see if it can help me. And you'll be pleasantly surprised. But now we're back into this discussion right here. So this becomes my primary focus because I want to be a buyer on a day like this. You would want to be a buyer in your demo account on these days. I got to be consistent, making sure you don't see this as investment advice, folks. All we're doing is we're studying the future probability of price delivery. Okay, that's really what we're doing here. Okay, if you cross the line and you say, I'm going to take real money and put it in the market and risk it doing this, you have made that decision. I never tell anybody to do that. Okay, but there'll be probably a day that comes in the future for some of you sooner than others where you feel confident to do this with real money. I don't want you blaming me for your wins or your losses because you earned them both. Okay, so just be aware that I have opened this discussion up like I do all the time. I'm teaching with a demo account or demo trade or paper trading account for my legal protection. But we're all watching real-time price action. It's all happening live, okay? And if these things don't work in live market conditions, whether it's a demo trade or a paper trade or even tape reading, which is what I want you to start doing. Don't push a button even in a paper trading account. Don't try to go out and get your funded account challenges passed. You need to do this for a couple months. Because once you get confident and you know what you're looking for, when price shows you this displacement to the upside, and then you wait patiently for it to trade right back down into this candlestick's movement higher, the market will want to offer down close or down expansion candles, which is sell side delivery. It really means simply this. The market moved up right here, one candle. And between this candle's low and that candle's high, there has not been any movement to the downside, which would be an efficient delivery of price action. If this was paint, and I've said this analogy before, you apply the paint with a paint roller to your wall right here. You roll it up, and then as you roll it up, the more you go up, you'll start seeing that the paint doesn't fully get applied to the wall. So what do you have to do to fix that? You roll the roller right back down over top of where you started to make sure there's an efficient or ample amount of paint between here, which is this candle's high, all the way up to this high now. Because if we went back all the way down here, so now what we're going to do, we have all this wall up to these highs to paint. So as an analogy, you're watching price paint on that canvas between this candle's high and these candles' highs. So it first started off real quick right here. So it wants to come right back down. And what that does, it affords smart money, traders that know how to use this tipping of the hand by the algorithm, to now enter, to get long, accumulate long positions. Where would they buy? I told you I'm giving you all the answers today. If you look at the high to the low, okay, I'm going to take these extensions off because I don't want them drawing any attention because they're not useful here. Okay, I'm not trying to hide something from you. I just want to make sure that we're looking at the pertinent levels here, the salient points, if you will. Here's the midpoint of that big up close candle. Okay, see that? We went past it, yes. But look at where the bodies are closing. Are they closing at or below that candlestick's high? No. Did we trade to that candle and through it? Yes, because we allow the wicks to do that. Remember, the wicks do the damage. So when you're using stop losses, I'm looking at where those wicks have done the damage prior to my entry or before I move my stop loss. And because I know I see damage was done here, and I know that it can overshoot this a little bit. Okay, so if I was long down here, my stop loss wouldn't be jammed up underneath these bodies. Because if it was, I would have been stopped out prematurely. So the fact that these candles are closing above the high of that candle, which makes this a buy side imbalance, sell side inefficiency fair value gap, trading down to that inefficiency, and these candles bodies not closing at or below tells me that we're really going to move higher and attack at the very minimum these relative equal highs. And because we're on a 15-minute time frame chart, we're going to attack that high, which I told you live that we would draw to, and it did. Okay, by in and of itself, that is all you need as a model. That's it. I didn't need to create a higher high of the day. I didn't need to move 100 handles or 100 points. You don't need that. In the beginning, you need to know what you're looking for on a very small scale, and that's 10 handles. Okay, minimum 10 handles. If it can't move 10 handles, then you don't do anything with it. Okay, but as price moves up in this range here, we want to determine how we can also scale in, because say you didn't get in down here towards the lower end, below the 50% of that gap between this candle's low and this candle's high. And I'll add that rectangle so that we know what I'm referring to visually. because if this is your first time, it's probably going over your head. And I'm trying to be very, very thorough, but not too thorough to lose you. But this big candle here, it creates an imbalance. And when it trades down like this, you want to be buying in that. Okay, I have students sometimes say, well, why are you buying here and down in here? Why don't you just buy one time? Well, because the market could go down just a little bit and then stop right there and go higher. It can go down to the midpoint of the gap, which is this level here, and go there and stop and go higher. Or it can go all the way down and close, or go past it a little bit like it does here. And I don't know that, but I want to secure my largest position. I'm doing my largest entry first. So if I was buying, like say for instance, I was going to do a position of 10 contracts, I would go in at 6 right here at the upper quadrant. He's teaching quarters theory. No, I'm not. No, I'm not. Here is 25%, and we'll toggle to 75%. Okay. And now what that does is it grades in quarters the low and the high of that buy side imbalance, sell side inefficiency. See that? So I could be buying right there at 6 contracts. I can add 2 more there and 2 more there. So I would be positioned for 10 contracts. Yes, my 6 contracts would be in a little bit drawdown when it trades to here. And then it would be in further drawdown because I add 2 more there when it drops down to here. I'm completely fine with that because my risk would be affording a move down to this candlestick's consequent encroachment. I'm at least considering it going to at least move that far. Now, why that? Why that? Because the likelihood of it coming all the way down to halfway of this wick, while it's possible, it's unlikely to do that. Why? Because we had that swing low there. So this wick went lower than this wick's low did. So this is the one that if it's going to reach into a wick or midpoint of a wick, it's going to go into that one as an extreme. And you can see we did go past it a little bit, but we didn't even get to the midpoint. See that? So that's how I would have placed my stop and managed my stop there as I was entering here, here, and here. And some of you might think, well, that's a lot of range. Well, it's relative to your account balance. It's relative to what you're willing to assume in risk. If the risk is too large and I can't facilitate that risk percentage on 6 contracts, then I would start with 4 or 3 or whatever. And then I would have to work with adding singles as that worked higher up. So it's how I'm balancing my total risk based on my equity. And then also what I anticipate is permissible in the current market structure. What is it likely to do? What is it unlikely to do? And then where's the gray area that feels like it's the highest probability of me being efficiently executing and not absorbing or taking on considerable risk and affording myself the potential for price to run in my favor. So if we have this here, I'm going to drop out of the 50-minute chart because everything I'm annotating here we'll be able to see on a 5-minute chart. I want you to see. Now over here on the 5-minute chart, I'll maximize it. Now look what's going on here. We drop down. Look how much work they're doing at the lower quadrant, the 25% from this candle's high to that candle's low. So there's 5 points inside of that range that I'm interested in. It's obviously the low, it's the high, and the midpoint, but there's 2 quadrants, the upper quadrant and the lower quadrant. Look how price is behaving. See what it did here? See how that overlaps with this down closed candle's high? That's an order block. It's not just a down closed candle that makes it an order block. It's the narrative that it's a bullish day. We did come down into this and close up that buy side imbalance, sell side inefficiency. And then does price support at the lower quadrant? Look what it's doing here. Is it doing it? Yes. Is that quarters theory? No. Is it algorithmic? Absolutely. And does the market run higher there? Yes. And then it drops right back down into this buy side imbalance, sell side inefficiency, that one single candle, which is the same thing we're annotating on the 50-minute chart that's seen here in 3 5-minute candlesticks. That singular one pass higher there is a replication of this larger one just in a smaller time frame. But look what it does. It allows you to see If it trades back down into the upper quadrant, which is completely permissible, and it trades down to this candlestick's high. What is the candlestick's high? Look right up here. What's the candlestick's high right there? 17,450.25. This candlestick trades down to a low of 17,448.75. Is that a lot of difference? Is that a lot of drawdown? No way. Absolutely not. And the market does what on this candlestick here? The low. 17,450.50. Only off by a quarter point. A quarter point. A tick is what that is. Order block, inefficiency, bias is bullish, sell side's taken, relative equal highs is your first draw, and 15-minute buy side up here. It was told to you when it was happening live. What did the market do? It rallied. So this would be an area where you can be a buyer too. This would be a real good area for me. If I was missing everything down here and I didn't do anything down here, I didn't do anything here, I could be buyer right there as it drops down to the upper quadrant because it's filling in that inefficiency there. And I'm anticipating and expecting price to do what? Expand to draw into the buy stops. Why? Because smart money bought the sell stops and they know that the market is rigged and they're going to wait, not because of buying pressure that's going to put it up there. No. It's time. They're waiting for price to be delivered there by the algorithm. It's a price engine, folks. It's literally rigged, okay? It's literally rigged. And all we're doing is looking for opportunities for price to do what? Show its hand to us. If we're bullish, okay, then it should show us sell stops being taken out or support in areas where there's inefficiency, like we showed on that 15-minute time frame. And when you drop down to lower time frames, all of a sudden you get more details than you never noticed before because you don't think there's an algorithm. If all this stuff was renamed by somebody else's work, why aren't they trading like this? Because it's not somebody else's work. So the market rips higher. Let's take our attention back to the 15-minute chart just for a second, okay? I got to get through this because we're fastly approaching 9:30. And what am I doing here? I'm going to minimize this. This, and then that's what I'm looking for. There you go. So with 15-minute time frame, we'll maximize that real quick. So we have this buy side imbalance, sell side inefficiency. It trades down into it, and then there's this gap I mentioned earlier. Okay. Now think. What is an inversion fair value gap? ICT, how do you know when you're doing your live trades and you're annotating them, you're calling an inversion fair value gap before it even forms, before it even trades there? Right. That's authorship. You would expect that, right? So let's go into it here. From this candlestick's low to that candlestick's high. Are you having fun? Are you learning anything today? Because I tell you, man, if I was my 20-year-old self and some guy was on the internet showing me this stuff over live price action, I don't know, I would be giddy. So now think, okay? If I'm bullish, if I'm expecting price to go up to here, and we're only right here, and we're trading up into it, everyone else that thinks that they see this as a liquidity void, or stops being hunted and a liquidity void, and we're going lower, they would see that as a short entry. Not me. Not me. And I can say that because you watch me do it example after example of live executions. When I called it on Twitter a lot, I'd say, okay, take that fair value gap, extend it to the right. What am I telling you? I'm telling you that this right here, this sell side imbalance, buy side inefficiency, where the candlestick's low of that candle right there, which is that. Let me move it over just a little bit so you can see again. Let me zoom in actually because I want to make sure you understand exactly what's going on here. I want your money's worth, okay? So this candlestick's low and this candlestick's high right here. That portion on this candle, that's what I'm highlighting. What is that? The algorithm will go right back to this time frame, right back to this range in price action, being this. That candlestick's low, and this candlestick's high. And we're gonna highlight, we're gonna darken up that rectangle's mid level. Okay, and I want that to be bolder like that. Okay, so that's what I'm highlighting there. Okay, and let's go back out to, oops, a little too far. Already, some of you already see what's going on, don't you? I can't believe it. I can't believe this stuff really works. So because I'm bullish, I'm going to look at old sell side imbalance, buy side inefficiencies, or down close fair value gaps as a rock climber. Okay, I'm going up. I'm trying to climb the surface of this rock surface to get to this liquidity. And maybe if I'm strong enough and hold on long enough, I might be able to get to the zenith of that high back there, like I talked about real time before I did it. If that's the case, I know that this imbalance exists. Because if this is there on the sell side delivery, part of a what? Part of what? A market that is potentially going higher, then I'm going to treat this as a foothold or a hand grabbing point as a rock climber. And I'm going to wait for it to trade up above it. My hand's going to use it to pull me up higher in my trade. And then I'm going to wait for it to, I'm going to get above it, and then I'm going to trade long when it moves into this area. Why? Why should I do that? Because it's going to act as support. Because why? If it's going to go higher, it's inefficient over here because it went down on this candlestick. Inefficient delivery and repricing for that range between this candle's low and this candle's high would be seen with candlesticks that go down in that same specific range that's highlighted in orange. Once we got above it, what did it do? It traded down to the low of it. And then what happened? Oh, look at that. Some mysterious movement to the higher side. And it ran into the buy side. Did it stop there? No, it ran right to the level I told you it would reach for. Okay? Is that hindsight, folks? Is that hindsight? Because this is the logic that I use every single time I'm making executions. Sometimes they don't pan out. I get stopped out. My entire move isn't given to me. Sometimes I enter with a pyramided entry, and I build in, and I absorb a little bit more drawdown in the trade that at the time I didn't want to see that much, but still I have to manage it. Just like you're going to have to manage. Every trade you get into, you have to be a manager of that risk. And every trade opens as a losing trade. You have to overcome the initial separation between where you bought and the spread, and you got to overcome the costs of that commission that you're going to pay, getting in and getting out, your real-time costs. So every one of us are losing traders, and you have to trade your way out of that. So the market does in fact do what? It trades down into the lower end and there. Now, before I start the live stream, and I got to get to this part because then we'll be at 9:30 where we can watch the opening range. I think I've already explained enough in here to justify why that's an inversion fair value gap. Inversion fair value gaps are old inefficiencies that are opposed to the trade direction you're in. When you understand this, you will understand how also my market maker models are not Wyckoff, because this right here is your unicorn. Second stage reaccumulation. Smooth consolidation. Smart money reversal. Low risk buy. Accumulation. Reaccumulation. Second stage. Whoop, whoop, whoop. Where's the biggest move? Right there. Hello. So oh, I love this. Anyway, we're going to go down into the 1 minute chart. Okay, so now we have all the details over here on the 15. We can see the same thing being shown on the 5 minute chart. Look at the bodies. What are they respecting? Midpoint of that inversion fair value gap. That's a signature. That's a signature. Once we start running, I know that a stop loss, if it was down here, could be traded right below that. And I don't care. I won't worry about it. It could trade down to the lower quadrant. It could trade right down to the lowest of the low. And I'm underneath that low. And that's why you see me sitting in my trades. And you're just waiting. You're waiting for it to tick there. Get my stop. If it was Forex, it would never stay like that because the spread would open up because the brokers do that. Forex is still allowing their brokers to use their own liquidity to reach and grab it. You're not in everybody else's pool of liquidity. When you're trading futures, everybody has the same high and low. That's an even playing field. That's why it's a gentleman's market. That's why it's a superior market. It is better than Forex. It is absolutely better than crypto. Futures, if you're going to trade, this is where you trade. I've proven it time and time again that if you know what you're doing, just because there is a spread there, they're not going to open the spread up for your one contract, for your micro contract. They're going to get your stop. If you got stopped out in futures, you placed your stop in the wrong place, period. That's the truth, folks. That is the truth, okay? But there is a way of trading, and that I've proven now, that you can have very, very pristine stop placement and management and still be able to be in the trade. But when I get stopped out, you see it. And usually it's good that I got stopped out, which is why I pay that stop loss to do its job. It's paid good money to protect me from losing larger amounts of money. But you look at this as I get stopped out. They beat me. They hurt me. They took something from me. No, you were protected. You were protected. It's insurance. It's insurance, okay? You're paying a tax, a toll to be part of this industry, this game, okay? You're not going to walk through it without having any losses. You're not going to. You're going to do it wrong. So let me get in here and map out what I showed, or what I intend to show you on the 1 minute chart. All right, so here is the 1 minute chart. And right in here, I started off this conversation with right below these lows, there'd be what? Sell side liquidity. And the market trades down, takes that liquidity out. At a time when we're in an inversion fair value gap, at a time where it would afford me a run up into 10 handles. Okay, so if I can get 10 handles there, I don't need to have the lowest low and I don't need to have the highest high. So if I know it can likely draw up to this price point here, that's these relative equal highs. You see that right there? So what is that? 17,487 and 3/4. That's this level here. 17,487 and 3/4. That's that high right there. So if I know it can draw to that level, and I'm under these lows here, inside of a fair value gap that is now an inversion fair value gap, that's this over here in the 15-minute time frame. Let me take that off. It's driving me nuts. Then I know this is a potential footing to send us higher. But is it time to make that price run there like that? No. But can I scalp it and get 10 points? Yes. And I'll explain what I meant by saying that. Just give me a second. We have the market trading below the lows here. I see the market taking out sell side. I want to be a buyer of that. But I saw a price on a 1 minute chart saying, okay, I can't get the lowest low, but I'm going to try to get as much as I can because I do believe we're going to go higher, at least 10 handles. What is this separation right here between this candle's low and this candle's high? If I'm bullish, it's a fair value gap, right? What kind of fair value gap? Inversion fair value gap. Watch. Right here to there. You see that? So in here, we're seeing price drop down, the market runs up, and we have a down closed candle, and we have market trading down into that. So we have several factors here that are building on this potentially being a short-term turn, and then price running higher for 10 handles. That's all you need. Well, there's a trade, and my first entry right there was inside that inversion fair value gap right there. See that? Then my second entry was right here as we touched the low of that inversion fair value gap. My risk was right below that low. Very, very, very small stop. And the take profit was before getting to 88 or 87, what is it, 87.75. Was before that, just to get to 10 handles. That's how you start tape reading. You don't do the execution. Tape reading is not pushing a button at all. You're just watching price as it ticks and books price and say, okay, this is where I'd hypothetically expect price to go higher. And then see if it does that. And you do this for months without even pushing a demo account entry. You cannot rush this stage. You cannot rush the stage of seeing price action behave and perform a specific way. Because you're expecting to learn something that is extremely technical. It's very challenging. You're competing against extremely smart people in a market that's rigged. And most of you argue me and fight me saying it's not rigged. It's buying and selling pressure. It's price patterns that's moving price. It's depth of market that's controlling this. And it's not. It is not. It is not doing that, okay? It's not. Now, this is not the time for the run for the day. That's the reason why I only wanted to use 10 handles. What time, Dave? What time will the market run algorithmically? For the note-taking folks, the ones that are really taking it serious, learning, macros in price action, okay? Unless we're talking about the last hour between 3 o'clock and 4 o'clock in the U.S. markets, okay? The last hour, 3 p.m. Eastern Standard Time to 4 p.m. Eastern Standard Time. There are 4 specific macros in that 1 hour time frame. Every single macro apart from that one is only 10 minutes till the top of the hour to 10 minutes after the hour. There's a macro in every single hour. There is no 19 minutes after the hour macro. There's no 23 minutes after the hour. Listen, folks, I understand everybody wants to have some kind of marketing ploy, some kind of gimmick to draw attention to themselves. But if you're saying there's a macro there, you are BSing. You're lying. You are lying, okay? A macro only exists 10 minutes before the top of the hour. That means, in this case, what time is this? What time is that right there? It's 7:51. Okay, that's 9 minutes before the hour of 8 o'clock in the morning. So if we take a rectangle here, and you go to 7:50 to 8:10, that is the macro. See that? What did the market do? We're bullish. Where's the buy side? Here, because it stopped right where it did over here on the 15-minute time frame too. That's this candlestick right here. That candlestick's high on the 15-minute time frame is that individual 1-minute candle right there. See that? So what does it do? It drops down at 7:51. What is it doing? It's dropping down to take the liquidity out here on that low. To do what? To start spooling. Where? To clear the liquidity above here. Sorry, folks. You can't talk about being algorithmic if you don't know what you're talking about. Okay? You can add the word to anything you want. Algorithmic camel toe pattern. Algorithmic cloudy skies pattern. Whatever. Just because you add algorithmic to the name of something doesn't make it algorithmic. Okay? The markets are doing something entirely different or decoupled from what retail is looking for. That's why none of this stuff is in retail books. It's why it's not a replication or renaming of anything that's ever existed before. So, when we see this, I shouldn't have that color because that's not what that should look like. We'll do this. And no midpoint because it's not measuring anything. So you can be trading futures or Forex with these macros. Okay, so it's not limited to any one particular asset class. Inside and center, right? And what you want to do is when you're tape reading, you want to spend the majority of your time focusing on what price is doing 10 minutes before the top of the hour to 10 minutes after, okay? What happens is the price engine that is the algorithm many times will spool, okay, during these times, and it will run to where the stops are, or it will run to where the inefficiencies are. And what do I mean by that? Inefficiencies are gaps, whether they're up close gaps or down close gaps. One singular candle moving in one direction, that's an inefficiency. And that's what we've been talking about and showing here. So this is the algorithmic price run. This is just the run-of-the-mill scalp. Which one would you rather be a part of? If you're trying to buy on a day like this and it's bullish and you're aiming for the levels I was outlining here when we first started our live stream, which one would you rather be a participant in? Some random price only entry versus a very specific algorithmic advantage where price will absolutely start spooling and reaching for liquidity based on time first. Clearly, it's not even a competition here. Seriously, look at this. Boom, all the way up to the high I told you it would run when we first started streaming. Okay, so there's clearly something totally different here that puts you in a different league. You're in a totally different league of trader. Your perception about price action is light years ahead of everyone else when you think like this, because you're aligned rather with price. You're in alignment with what the algorithm is likely to do. You're going to read it sometimes wrong. Sometimes I do. Sometimes I get all bent out of shape and feel like I want to show off, and I do something that is a little too beyond the scope of what the structure at the time is I'm trading in. Sometimes I'll do that. But when it does this here, then we can go back into, okay, what are we looking for if we miss this move? Well, what's this low? Let me take the executions off real quick. And we'll go right into tape reading the opening range. We have a low, high, lower low. That makes this up close candle a breaker. I don't draw all this stuff on my chart, but you should, because it'll help you frame everything. And if you're back testing, this is what you want to annotate on your chart. You want to have all these types of things on your chart, because it helps you identify it and remember visually what these things look like. And the market trades down here. And also, what is it doing here as it trades down into that bullish breaker there? This is not support and resistance, because support and resistance would have been, okay, well, it went above here, so it should stop there and go higher. That's how I lost money in the 90s, because I thought it was so easy that support and resistance is going to be the be all end all, and it wasn't. I lost a lot of money trying to do that stuff. And it's the entire range of the up close candle. The highest up close candle is your breaker. In this case, it's not even trading down to the low, but what is it doing in addition to that? You see this? That right there is a nesting of two PD arrays. So this is an old buy side imbalance, sell side inefficiency, fair value gap that was used right here, and it went up. But did it rally above that high here since this movement here? No, it didn't. It's consolidating. So it drops back down to it here, and you're still inside that breaker. So you have to afford, if you're trading long, your stop can't be so trailed up to get stopped out prematurely. So that's all factors of how I would measure where I would move my stop. So if I was going long down in here, if I went in and bought this immediate rebalance, which is the open trading down, immediately going back to this candle's high, that is extremely strong. And I'm not making that up for the purpose of being here live and it had already happened. Go back to where I was talking and teaching immediate rebalances. They are the bee's knees for entries. If you can get in, or if you're supporting your trade with a stop loss below a immediate rebalance and your targets or liquidity hasn't been traded to, the market is absolutely not going to your stop loss. And you heard exactly what I just said. That's not me exaggerating. Don't take my word for it. Look at my examples when I'm executing. Go back and see if there's ever a immediate rebalance, my stop loss is just above that or below that in relative terms to the direction of the trade. This is logic that I keep using all the time that repeats over and over and over again. So anyway, that's the framework. This right here is all I'm going to be doing here in Robbins. I am not going to need this. If I did this, 9 weeks, I'm winning, and nobody's ever going to come close to me. But I want to spread it out over the whole duration of the year. I'm coming in real slow, and my whole program is every single month I'm going to be going in there doing base hits. Because if I go out there and I smash it out the park doing with everything with real Enigma, not what's being passed around on the internet as Enigma. If I ran Enigma on Robbins, literally, I would triple Larry Williams in 3 months. Literally. And that's the truth. But I want to prove consistency. I want to prove base hits are enough. Everybody else is going to go out there and try to swing for the fences, and that's going to do them in. Small base hits. And the heavy lifting will be done by compound interest with money management. I don't need to make a bigger trade than this. I don't need to do that. I don't need to do 20 to 1, 50 to 1, 5 to 1. I don't need that. These types of trades happen all day long. These trades only happen at certain times of the day, but they repeat certain times of the day. So with that, I'm going to take about 2 minutes, go wet my whistle, get a drink. This is a bathroom break, and we'll be back here in a minute or two for the opening bell. All right, folks. Just peeked at how many people are joining us here today. So it's like 13,000. I'm surprised. I wonder how many actually left. All right, so we are just about 30 seconds or so away from the opening bell. And I want to magnify this chart here. And we will look at the difference between the regular session and where we are right now. So here's where the opening range settlement price is down here. And we're going to watch where we open up here in about 2 seconds. So we're way up here. You see that? We have already moved a great deal up. Now that gap is going to be a draw. It's going to want to go back down into it. It does not need to go all the way back down to where we settled at yesterday. But this initial run here, that reaching for or attempt to close in the gap, that's usually what you anticipate. Does it happen to fill the gap always? No. Most of the time, it will make an attempt to do so. What I do is I look at where we open up at and where we were selling at the previous day. And I want to get quarters of that. So where we open to where we settled at previous day. So what does that do? It gives me an upper quadrant, the midpoint. So this will be like a midpoint closure or mid-gap close. Then we have 3/4, which it's delivered to here. On bullish days, it can do this very thing here. It can go down to the lower quarter and leave that remaining portion open. And traders that want to see a gap closure, they'll fight real hard to get down there, or go short, or try to reach for that. What I like to do is I let them try to do that. I'm not trying to outpace them. I'm not trying to outperform them. But what I'm interested in, does it have a willingness to get down here and close that? Because if it doesn't close this gap and starts to rally, that to me tells me that this is so strong and bullish that it's not even interested in going down here and reclosing or closing in this inefficiency that's here, which is a real gap. There's no trading between these two price points based on the difference between where we closed yesterday, here, the settlement price, to here. So there we go. We traded down into it there. So when I'm watching price, and when you see me doing my executions, if I'm trading right at the 9:30 opening bell, because I have monitors all in front of me, my other screens, you don't see me doing this. But that's exactly what I'm doing. I'm getting the difference between where we opened up at and where we settled at. Okay? So now this is done, but that gap can act as resistance, meaning that this line here, if we trade back up to it, it could act as resistance and then send us lower. That's the length of importance that I place on it. And any one of these quadrant levels, if it retraces to, I would treat that same idea with it. It can act as a means of repelling price. So let's go back to electronic trading hours. You can see that price run here. So we're back down inside of that initial 15-minute buy side imbalance, sell side inefficiency. Sell side is right below here now. So that would be the draw on liquidity. There. It's a fast run. So this gap to its midpoint right in here, that could act as a point of resistance. Let me get this off. And while tape reading, you're not trying to do any executions. If there's a setup, I will push the button in front of you. But tape reading is where you're literally looking at price and you're just watching and observing it. You're taking mental note, saying, okay, this is what I believe it should do next, where it should gravitate to. My eye's right here. I want to see where we close with this candle. If we close and leave that there, do we trade up into it? I have lots of screens, and when I'm executing, I have charts that have these measurements on them, but the chart I'm trading off of has nothing. Okay, you see this area right in here? That right there is your first imbalance inside of the opening range. Huge, huge importance is placed on that, okay? Many times you'll find that the day, if it gravitates above and below it, it will use that first imbalance a lot for several trades. You know, it could end up becoming a point at which it turns the daily range bullish or bearish. But the very first inefficiency of a day, I like to use that. There's one right in here, but I don't like that one here because it's a little too small and it's inside also that old imbalance, that shaded green area here. I like that. There's nothing here that aligns with anything else. So there's really no nesting aspect to it. So I'm watching price. I want to see if it can reach back up into this area here. It's a really nice price run. So I want you to think about where it ran to. It cleared those stops above that 15-minute time frame high we were looking at the beginning of the stream right here. Now we've taken out sell side below the low this morning at the London lows. Now I want to see how we trade at this imbalance, because it could do this. It could trade up through it and then come back down. And what would that become then? What would that become? Inversion fair value gap. And it need not create a new higher high than it's formed here at 840. We don't need that. We're just looking for periods at which we can anticipate a turning a price run that's obvious that's going to an inefficiency or liquidity. I'm looking at still that longer term, I don't want to fight that bias being bullish. So yes, we've seen it take out that low on the 50-minute chart here, and you can see it also on the 5-minute there. That's what this level is here. This line right there, I'm going to darken it up and make it black and bolder. I messed up. I should have done that. There you go. All right, so now we're back into that gap right there. Now, does it come back down in and treat that as an inversion fair value gap? This inefficiency on the 15-minute time frame over here, it's an orange, that inversion fair value gap. I'm extending that over here. And I'm going to take the quadrants off that other stuff so it cleans the chart up a little bit. See that? Down close candle, fair value gap, potential inversion fair value gap. Does it have the willingness to draw up into that 15-minute inversion fair value gap? And does it also get through that and then treat it as support? Because these highs right here, way too clean, too smooth. So what does that mean? Buy side rests just above that. See, this is all the stuff you see me do in my trade executions. I'm annotating it. Al Brooks mentioned in one of his videos I looked at yesterday, saying that the 1-minute chart moves too fast. You can't read it and anticipate, whatever. See how we went down into the inversion fair? I'm sorry, the old gap that's over here. See that? Buy sign imbalance, sell sign inefficiency. We traded above it here, came back down and touched it. See that? And now, does it reach up into that inefficiency on the 15-minute time frame? So you're not going to learn that from a chapter in a book that I'm writing. Okay, you have to see it over live price action, and that's the point of why I share my execution videos, because I want you to go through the charts and study, see what those factors were at the time when I was doing the execution, or when I moved my stop loss, or the things that I didn't execute on. I get a lot of questions like that in my comment section. Why didn't you take this trade or that trade? Or why didn't you use this candle or that candle? Because the flexibility that's offered and afforded to every one of us, my models are not always going to be germane to what you anticipate and expect in price action. Okay, so we traded up into the inversion fair value gap. So look what we did. We went down, took the sell side, and then we rallied up in. I said, watch the inversion fair value gap. It trades above it, trades back down to the midpoint. You see that? And then I said, we want to see if it expands up into the inversion fair value gap here. Trades up into it here. Did it get all the way to the high of it? No, but it got to the midpoint. So now it can range between both of these inversion fair value gaps until the 10 o'clock news comes out, which is a medium impact news driver. Ultimately, my interest lies right in here. I want to see how we trade after we clean this up, if at all. If it fails and just starts to fall off, I'll mention what I think that means for us at 10 o'clock, right, minutes before 10 o'clock. But right now it's too early to determine how they're going to use that news. Now, if I was to stop right here today, this in and of itself is a huge leap in understanding, even beyond the scope of what I've shared in the private mentorship lessons that you can watch on the YouTube channel, because we're looking at it over live price action and making emphasis over specific points of price action and ignoring things that you maybe have stressed as these were more paramount issues. And those are the hindrances that you're creating for yourself. And by doing it, the experience that you gain helps you eliminate all the things that you're making big, important issues right now. They're not. Trading with real money, trying to get a funded account, that's not important right now. That's the goal, to be profitable as a trader, but that's not the goal right now if you don't know what you're doing. If you don't know what you're doing in terms of reading price action, that goes without saying it's not going to happen, right? So I got to text my wife. She's got the heat up too high. Good grief. I'll leave the woman to herself and she cranks up the heat. All right, watch how we trade in here. There's a volume imbalance right there between these two bodies of these candles. Volume imbalance is the weakest of all of my PD arrays. Now, the importance is how we use them, okay? Because they allow price to trade through them, but if they keep going back to them and utilizing them at a later time, that's obviously, to me, it's important because they're like little measuring sticks in terms of the magnitude of a price run. How much strength is behind the price run? If it goes up here and trades into a volume imbalance and then turns, to me, that is indicating the weakest of all my PD arrays is able to stop and stave off higher prices. To me, that indicates that it's not as bullish as I would like to see it be. I want to see it trade up to that volume imbalance and go through it and maybe come back down and touch this candle's close or this candle's opening and then send it up into the buy side. That's what I'd like to see in this instance here. But they can be traded through multiple times, pass through. But they're like a little measuring stick for the strength of the price run. But they still act as a magnet for prices as well. It can pull price into them really easy if you're on side. You see how it's offering initial resistance in here? And that inversion fair value gap is this gap over here. Okay. So I purposely chose this day because number one, we have a market that's traded at all-time highs. It's pulled back. We only have one news driver. It's at 10 o'clock. And we're part of a consolidation here. All this consolidation. This is a very, very challenging market condition. It's not an easy day. An easy day would be where you can clearly see relative equal highs or relative equal lows, and the bias is in line, and there's a narrative that it would run for that particular price run. And then you simply wait for the time of day to trade. That's not what we have here today. But this is exactly what you're going to encounter. And if you have been trading for any length of time, you're going to find out that you do most of your trading on the difficult days because you think that you are going to finally win. Keep pushing, keep pushing, keep pushing. And in the days that you don't really know what to expect, but you get lucky, you stop and you end up doing really, really well. If you reverse the logic and try not to push on a day that, if you feel confident that it's not easily discernible where price is trying to reach for, don't trade. That's an easy thing to identify. As a new trader, it's just about every single day it's like that. Because you're nervous, you're worried about, oh, I might do it wrong. But over time, tape reading, getting a feel for what price is doing, how does it behave, how does it deliver? When you have that for months, you're going to see things that tend to repeat over and over and over again. And that experience, that's the part that I cannot transfer to you. I can lend you my experience and say, hey, over my shoulder, this is what we're watching. We're observing this. We want to see this or that. That's not you having experience. You're experiencing my experience. But once that experience ends and I turn off the live stream or stop communicating with you, then that void of inexperience comes rushing in and it causes anxiety, which is the very reason why I've never taught by tethering you to my executions. Because to do that, it formulates and forms this bond that is not, it's not realistic. It's not constructive for you as a trader, because you're going to trade independent where nobody else is going to influence you. And you need to be willing to assume all that responsibility. And for the folks who are talking about push a button, at 10 o'clock, I want to see what we do with the report. And then whatever inefficiency or whatever we have at the time, then I will push a button. You'll see me execute it. But until then, we're going to listen to me talk. The factors of experience that you're going to get, you can't place any value higher than the highest form of value by gaining experience. And you can't discount it. You can't speed it up. And whatever we're doing here, watching price action in the early stages of our development, that's still the same thing you're doing between trades. So why are you trying to avoid it? You're going to spend more time between trade executions than you are in a trade. So you might as well warm up to the idea that you're watching candles paint. And if you hate it, then you're not a trader. If you have to be passionate about this, if you're complaining about price, oh, why won't it do something? You're not a trader, man. You're not. You will literally roast yourself. If you give enough rope to yourself, you'll hang yourself. Because it'll be your subconscious way of taking yourself out of something you don't really want to be doing. And you'll just say, well, the stuff never works. Nobody makes any money. Everybody's a fraud. When it's just you not being patient and not knowing what you're doing, and you're expecting to learn how to do it real quick, real fast. I like this potentially running up into that buy side now. You see how it dug into the bodies here? Went back down deeper into that old buy side imbalance, sell side efficiency on the 15-minute time frame. See that? We dug down into upper quadrant of it, and now we're reaching back up. So I like to see it continuously run here. What I'm interested in is, do they use the 10 o'clock news driver to reprice to this area here and then sell off? I'm not saying that's the trade I want, but that's what I'm waiting to see. Do they use the 10 o'clock news as a smokescreen to clear this little area up, maybe bump up above? These relative equal highs are too smooth too, in my opinion. Do they run up there and then reject, or do they run up and go through, and then we start turning our attention back to this old high here on the 15-minute time frame, which is this line here? That's the same line that's over here on the 1-minute chart. So when I'm trading on my charts, when I'm looking at them and I'm executing on them, I have nothing on them. I do have other monitors that have notes and annotations. I don't have all this stuff drawn out on it, but I'll type something out like watch this level after this macro or that particular macro. Once this occurs, it's the same thing I would have on my notepad. If I'm out in front, like right now, I'm in my trading office. I have all my monitors off in front of me. The only thing I'm literally using right now is the laptop I'm sitting in front of. All my other monitor and main system, the hardware, all that stuff is off. There's nothing, there's literally nothing going on there. And so I'm forcing myself to read and interpret price action on one single screen, even though I do have it set up as a template. And this is the time frames I'm using, okay? So, when you've seen me share my trading space, and I did videos or pictures of it, and in my Twitter spaces, I mentioned that I have a little notepad next to me. The same notations that I would have on specific charts and specific time frames, that's what I have written on my notepad, okay? Macro times and targets and price, where I want to see price at this level between 950 and 1010. Or I want to see price reach to this specific inefficiency or fair value gap by 1050 to 1110. So they're like mile markers. It helps me measure the strength of which, if I'm bullish or bearish, it should reach these thresholds in price based on my experience. And then I will use that to determine whether I want to take a trade or not. So it's not like secret recipes on my notepad that if you saw it would mean nothing to you. It literally would mean nothing, but that's what I'm writing down. Specific price levels and time at which I want to see them be traded to. That's all it is. All right, so now we're in that old inversion fair value gap here, and I want to see it trade into this, and it may go down to the midpoint of this wick right here, that little wick right there. may overlap with that, and then I'm going to see it expand up and clear this, and maybe get up into this one here. So if you let me do it like this is the real initial draw I'm looking for, but overzealous price run could take us up in here and clean that up a little bit, because that is also a little gap here between this candlestick's low and that candlestick's high in the buy side. So, hopefully what time we've spent so far together today, you can see that there is a rhyme and reason as to what I look for and what price is going to respond off of. And it's not classic support and resistance or harmonic patterns or anything like that. It's not Wyckoff. It's inefficiencies and liquidity. And I'm framing everything on the basis of the certain time of day that it should behave a certain way. Okay, when price should start running. For those individuals that have the resources, like remember we went above this volume imbalance. Let me put that lines in here before I go any further. And I mentioned that we can pass through on these, because this is the weaker of all of the PD arrays that I have in my repertoire, but they still act as a magnet. Okay, so that would be labeled, for you would label that as volume imbalance. Okay, so see, it can pass above it, pass through it, but it draws price up into it. Now, does it have a willingness to get through it now that we're using the inversion fair value gap here? Does it have a willingness to want to get up into and dig into this liquidity? Because so far, the only thing we've done is we reached up into this inefficiency, which is a volume imbalance, and then we have this inefficiency here. And when you annotate this one, this sell side imbalance, buy side inefficiency, you have to incorporate the volume imbalance too, not just the high of the candle. And I've mentioned this in passing in previous discussions where I see it and it's pertinent. So you would have to have it noted like that, but not that color. So I'm not sure what I would use here. It's not the same color, is it? No. All right. So we're down into, look at the bodies. What is it respecting? The upper half of that inversion fair value gap. So now we're back at the volume imbalance. Does it expand through and get into here and then dig into this? We'll do it like that. That accomplishes everything. The last portion of that sell side imbalance, buy side inefficiency, and that high. So there's buy side and the little portion of inefficiency residing right in there. So again, back to our analogy, treating price runs as if you're bullish, like mountain climbing. Okay, I'm looking at old inefficiencies over here and planning out where if I see price climbing, and if price is the rock climber, and I'm basically piggybacking that rock climber, I'm going to use what the rock climber would see on the surface of the cliff that he's trying to scale or she's trying to scale, and determine where my footing will be. And none of this has anything to do with support and resistance. I'm basing it on inefficiencies in price action. That's all I'm doing. Is that complicated? No. Not every single one of my PD arrays exists in this price run. There's no breakers in this, right? There's no breakers here. But where there are inefficiencies, remember I told you that this one here I wasn't interested in. Notice that. And it didn't really do anything at all. That's experience. This one was the one I liked. We traded down into it here. We overshot it here. That's fine after going above it. But look at that. That right there is perfect. That's perfect. You cannot improve on perfection. Price runs up into the inversion fair value gap you're looking for. It trades back down. It doesn't even trade to the inversion fair value gap here again as a support. And when I taught on Twitter and Twitter Spaces, I mentioned that when I'm looking at PD arrays that don't even get traded to when they should, what does that indicate? Exceedingly bullish in this case. And I said, I like it when it was here. I said, okay, I think it's going to go up in the inversion fair value gap. I gave you volume imbalance and this inefficiency here. We want to see it expand up and dig into. And it looks like they're going to use that 10 o'clock news probably to do this very thing here. It's all hindsight. That's funny. That's funny stuff. All right, just 3 minutes to go, and that 10 o'clock report comes out. I wonder how many YouTubers are looking at this live stream and took anything against what I used here in my annotations. I don't have a way for you to comment because it's a live stream, but I'll post something in my community tab. You guys can reply to that. Let me know if you did anything based on this stuff. I'm trying not to think about it right now, but I mentioned in the beginning not to use anything I'm saying as a means to get into a trade. But I know invariably there's going to be someone that has done it, and maybe they made some money here this morning and they're all giddy right now. That could change real quick here in a minute, so just be careful. Now, in terms of difficulty versus a real easy bread and butter type day, this is one of the harder days to trade in because you're trading after a day of reaching into all-time highs, and we're in a consolidation. You can see it on the 15-minute time frame. So you have to reference where your liquidity is. This pool of liquidity has been taken. This pool of liquidity here has been taken. So where are we? We're inside the range. That is extremely hard for a new trader to trade in, because what can you build your confidence on? Where is the draw on liquidity? It's real hard to do that because we've already done what? Both on side of the 15-minute time frame buy side and the sell side. So we're inside the middle of the range. So you have to have a great deal of experience or trade with extremely less leverage than you normally would, because you're probably going to be wrong. Watch this little gap right here, okay? And there's this down close candle, so there's a little bit of an overlap there. It could trade down into that and send us up into that, or 10 o'clock news, they use that just to reprice up to here, and they leave this intact here. I don't know that because everything I just mentioned, the buy side's taken and the sell side's taken, and we're inside the middle of the range. So it is a 50-50. Gun to my head, we're going higher to clear the buy sides up. And that's about in 20 seconds now. News will hit. On easy days where it's all one-sided and you know the daily range is likely to expand to a direction that you derived off of a weekly chart. Everything I've described on my video library on this YouTube channel. Trading's easy. It's using all these types of things I just outlined here and getting in and just letting it go. Here, today, admittedly it's a little bit harder. Okay, 10 o'clock, the news should be impacting the market. I just realized I don't remember if I turned the microphone back on. Hello. Yeah, it looks like it's showing. That would have been embarrassing. I did that with a video I was doing for my other project, and I talked 2 times for 2 hours in the last week and didn't have the microphone on. All right, so we are in a low, high, lower low, up close candle. I'm watching price how it behaves in here because of a potential breaker. See how gnarly price is right now? Let me pick a different word because someone outside the United States may not know what that means. Do you see how messy or sloppy price action is now versus where it ran right here at the opening, and then we started climbing up? Everything seemed pretty obvious. Now we're in some really gnarly, really choppy, really uncertain, could go either way direction type of price action. As a new trader, you're going to find that you're going to see these types of days and feel like they're challenges, and you want to be right in it because you feel subconsciously you don't know what it's going to do, but you want to go in and push a button and find out. And when you get it right, the foolishness is to attribute that as skill. I did that when I was in my 20s. When I see this price action here, I see this as this is uncertain. And while it's my intention, I want to push a button. I intend to do so should it present itself. If I don't, I will live stream tomorrow and do it in front of you. But I have to force myself to follow my logic. I don't want to just simply push the button because it's something to do. So I'm watching this in here. I'm going to annotate that. This is what I mentioned moments ago. We're right there in it now. Now, if we come back up into this inversion fair value gap or just touch the bottom of it, it can go about midpoint of it. Why just the midpoint? Because look how many times we worked down into it on the upper half of it. And now we moved away and below it. Now coming back up, it's allowing, or I would allow rather, price action to get up into the midpoint of that, and it would be completely permissible. Something that wouldn't upset me if I wanted to go short. And that's what I'm looking for. I'm looking to see if they use all this buildup in here to move lower and then attack that low. If we go below that low here, I think we might move a little bit lower than just breaking that low. All right, you see where the body's closed in here? And where this one opened up at? Right inside this gap. And we have that down close candle I mentioned, which is an order block. See that? It literally can go either direction right here. That's the definition of low probability. High probability is where you can see it. Everything is leaning towards a specific point of liquidity, buy side or sell side, or an inefficiency above or below the marketplace. Okay, went right back up in the inversion fair value gap halfway point, and then rejected that. Remember I mentioned that it worked already the upper half here and moved outside of it. Came right back up to the midpoint here and moved down to a lower low. Nothing in here except for the order block is of any significance to me. So I don't have anything yet, but I'll stay with you until I do. All right, see this down close candle here? Half of that essentially is right there. So I'm watching how it behaves here. The next candle, I want to see, does it open, trade down to half of that, and then rally up. Gun to my head, I want to stick to the all-time highs been traded to, and I don't want to try to pick the top there. So I'm really looking to something as a long, but I'm being cautious because it really is, if it could go either way.
And looking back at what we've been doing for the last, what is it, 19 minutes or so, either side of the marketplace would be frustrated right now. Shorts wouldn't be satisfied and longs wouldn't be satisfied. So that's also one of the things I look at when I'm watching price. I'm trying to weigh out what the sentiment would be for long holders right now. What would be the sentiment for short holders right now? Would they be feeling confident right now? Would they feel overconfident? I'm gonna I'll let it pass. Really, really slow. See, I was going to buy it when it was right here because it went down into what I was saying that mean threshold would be. But already I'm glad that I didn't do it because this should have, on this candle, we should have already cleared this high. And I would be not happy about that right there if I went in that long. Experience, there's no substitute for it. I think it wants to go back down in that range in here. 5-minute chart. Let me magnify this real quick. Here's the 5-minute chart. Here's the buy side initially that we were talking about going to, and then eventually this high right there. We traded to it. So on the 5-minute chart, we have came back up into this area here. All of the sell side imbalance, buy side inefficiency has been repriced here. Look at the bodies. We traded back up into it here, and we wicked through it a little bit. Okay. My higher time frame bias says don't try to pick the top. They've already ran buy side here and really sent it lower and took out the sell side here. So we're inside the middle of the range. If you look at the fib here, here to here, here's 50%. We're just hanging around, meandering around midpoint of that range from the high to the low. Whenever you're like that, and both sides of the marketplace have been taken on the 15-minute time frame, both the buy stops up here and the sell stops below over here. Let me take this off. This was denoting the London session. So right below that low, that was sell stops. And right back in the middle, okay? I can promise you, if you do most of your trades right here after things like that, you're going to have the lowest strike rate. You're going to be frustrated. You're going to be losing money. And it's going to cause you to want to go back in right away and try to get it back. Versus trading at range extremes once the liquidity is taken, and then right before you get back to the middle, or from up here, before you get back to this low, to that high, that midpoint, that's trading in the middle of the range. That is so hard to do consistently. It's so hard to do it. Even myself, I would frustrate myself if I pushed real hard in this condition. And I did that to myself as a young man. All right, down close candle, inversion fair value gap. I'm going to give it a go. It's got to touch it though. That's why I got it down to one contract here. Because if I get stopped out, it won't do harm to what would be the results of today. And Hang on, I'm watching it. Don't need this. Keeps. Now, from this candle's high and where we have on this low, this is usually where I go in and I'll buy it with a limit order. I'll put the stop loss just below consequent encroachment of this candlestick's wick. And I'll aim for that buy side right there. So again, the probabilities are 50-50 here because they're inside that range. I'm sticking to the narrative of the higher time frame. I want to see that higher time frame daily chart move higher. I'm avoiding trying to go against that grain. I'm not trying to predict the top of the marketplace. I'm not trying to impose my will. I've looked at it here, I've watched it, and it has not shown a willingness to want to go lower sharply, and it just keeps pressing against anyone that would have been trying to go short. So the stop loss would have to be below the inversion fair value gap, because right before we had this high taken out, it's this candlestick's wick. So about half of that right here. Let me zoom in, show you what I'm referring to. Right there. We'll take the quadrants off. Yeah, right there. So that's right there. My stop would have to be below that. So it can come back down into this shaded area and move higher, or come down and stop me out. Either one makes no difference to me. It's still chopping and moving around in a range. Now, there's sometimes when I'm taking trades, if it is indecisive and I feel confident that it's going to be one-sided, where the market will move in one direction that's bullish or bearish, whatever, I will use one contract to go in and see what it feels like to be in that trade. And does it reward me immediately once I get in, or is it immediate pressure when I get into it? Like, not selling pressure or buying pressure, but physical. Like, does it induce uncomfort, discomfort in me? The better trades will reward you immediately. They'll immediately reward you and put you on side and start delivering in your favor. The trades that are not where you're on side usually are ones that really make a run against you as soon as you get in. And then the problem with that is if you're a new trader or if you're inexperienced, you'll feel that and then you'll fight through it and you'll ignore it. You'll discount it and say, I'm not going to let go of this trade. I'm going to hold on to it. And that losing trade becomes larger. And if you have a stop loss, you end up moving it farther away. I did all that stuff when I was 20 years old. I did all those things, or I didn't use a stop loss at all. And when you're on the right side of the marketplace, it'll move immediately in your favor. In this instance, because I mapped out what we did on that 15-minute time frame and explained the difficulty of where we are. So to communicate, number one, the difficulty of trading in the middle of the range. Two, even if this pans out, I don't want you to feel inspired to trade in this type of condition. Don't do this, because you'll be met with the adversities that's plaguing a middle of the range type of trade. Now, what has the market done in the last 25 minutes? Nothing. Was 10 contracts on 10 funded accounts the best way of trading today? No. There's your stop rate. Oh, I thought I was going to get near there. Here it comes. There it is. Oh, you took a loss. One contract in a market environment that is already explained to you as difficult. Sitting in this environment like this, you have to determine where are they more inclined to take it. Are they going to go higher or are they going to go lower? These are the two obvious levels I see still. But we're in the middle. It can go either direction 50-50. As a younger man, I would get mad and I would go in there and trade with the same or even more contracts, trying to get my money back from the bond market. Give me one more second here. I'm going to walk away just for a second so I can get another bottle of water. Okay. All right, see that gap right here? I'd like to see this stay open. This is the important conversation, or breakaway gaps are coming into the conversation. I'd like to see it stay open. Why? Because we're in consolidation. It gapped, that fair value gap, that would be, if it trades right back to it, then it completely collapses the idea of it being a breakaway gap. Now is that immediate rebalance. Immediate rebalance and potential breakaway gaps. There is a time between one or the other. When this candle closed, if it would have closed it and left it as a gap, then I would have treated it and labeled it as a breakaway gap. This, so far, I want to see, does it send it lower? Trading in the middle. All right, so I'm going to go here real quick and go to a 60-minute chart. Halfway on that wick is about right here. So let's see. If we were to lose ground here and take out that low, that gap right here, that would be a nice draw, but that might not be in the cards here. Let's go back to 15. All right, so we are in that old 15-minute buy side imbalance, sell side inefficiency over here, right there, and inside this inversion fair value gap. If these are to fail and price comes back up into it, then I would entertain the idea of revisiting that low. But I'm looking to see if it wants to offer willingness to want to rally there. Okay, right at that low right here. If you can trade back up to that, I'll try a short there and aim for a run on the liquidity. Don't copy me. I may have missed it. Yeah, I think I missed it. One contract trading. It's boring, but that's how you start. I promise you, when you first start trading one contract, it's going to feel like a stranglehold. It'll choke you. Any movement against you, it'll be like, man, why can't this work? Why can't that work? There you go. So I'm sitting here thinking, how many of you are putting stop loss there? And the 15,000 are watching. Oh, that's 15,000 stop losses right there. Let's run right to that. All right, so now I'm going to clean this off here and take this off here. From here to here, we just watched it book to that. Okay. The buy side here, sell side below these lows, down into inefficiency. A gap in here, institutional order flow entry drill if we can go below that low. Okay, that's that. We're still $1,448 simulated profit on the day. All right, so now look at the 15-minute time frame over here. We had a sell side taken there. We came down, tried to make a pass for that. Didn't reach any further than this imbalance here. And now we have this. We have this imbalance, and we have this small one right here. With buy side that has not been tagged here or here. And then there's buy stops resting right above here. So I'll add that one too. I'll take this line off because it's not needed. That's the old relative equal highs. All right, so now look, we have consolidation. We drop down, smart money reversal, low risk buy, went against my trade. And now we have up close candle here, which will be treated as a bearish order block if it was bearish. Did it respect that? No, it traded through it. So now watch this up close candle over here. There, and let's shade it this way. I executed on the basis of we dropped lower, we came back into 5-minute inefficiency, rebalanced it, failed several times going higher, broke lower, using this up close candle, trying to see if it will work towards this low right here. Whether it goes below it or not, it's irrelevant. Inside a volume imbalance there. Still stuck right in the middle of that range. That takes us to a little over 1,100 hours. Still on the day. Yeah, 1185. And still stuck in the middle. Now imagine if you go in there and you're adding more contracts each time, or adding additional, what is it, XFA, XF, whatever the accounts are that everybody links together. All right. Compounding each time. It doesn't take long to erase what you have. This would be my last attempt here for any run for that buy side. If it were bullish for the remainder of the morning session going into lunch, and if they do want to take the buy side above here or over here, they would want to use this area here for it. If it fails, then I would close the day and be content with what I have. So think about what's being shown here. You don't have a real easy draw either side. Long term are bullish. Shorts have been short-lived. Longs are just being stifled. And to me, I think that they're allowing these stops to feel safe right now. right, so now this inversion fair value gap, if it drops back down, it probably won't reach to my limit order. So I have to factor in this range here, which is why, remember on, what was it, Twitter, on the spaces, I would tell you, grab that fair value gap at whatever time candle on 1 minute chart and extend it to the right. That's what this is showing here. It's that type of understanding or event. And that would be my last attempt for today. If it stops out, I'll be done. And it would still be a net positive day. Stop loss will be below this fair value gap or inversion fair value gap. Buy side here, here, and over here, and in the middle of the range. So small little fair value gap we traded into there. I would want to see immediately this candle or the very next candle start running higher. If not, the probabilities of this trade fall off precipitously. If they want to keep it in a range, there's nothing you can do about it. You can't make it happen. You can't force it out of it. You can't make them release price. The only thing you do is identify it and stop. Not, well, I'm going to eventually catch the move. I know if I leave, it'll move. Let it move. The market's not predisposed to go in one direction. It's going to be hard. No matter who's trading it, no matter what they're using to trade with it, it's going to be difficult. And it spends a lot of mental capital. Mental capital is much more valuable than what you have in your account. Your account, that can be replaced. I mean, you can get a job, a second job, sell things around the house, put that money back into the account that refunded. Or if it's a funded account challenge and you blow it, you can just go pay for another one to get back in again. But mental capital, that stuff, that's anguish. That's something that is terribly expensive, because whatever you do on a day like today, like if you push real hard and you compound and you compound and you compound and make the losses larger, or keep going in through frustration thinking that you're going to finally get that big run, it's going to happen, you just got beat up and you were doing it wrong, and then finally you get the right side of the marketplace or it runs in your favor, that might not happen. So you have to be aware that that is always still potentially looming. You think you see an opportunity there, but this is a very difficult market environment to be in. I mean, look at it. It's very difficult to be trading inside that range. Every price run is plagued with a very short-term duration. And it's just gravitating right back to the middle of the range. Seeing it in my hands should hopefully try to reinforce it. If you see it like this, don't push. Don't try to go back in and revenge. Don't try to push real hard. If this were to pan out and the trade, moves in my favor, I don't want you to feel, and I'm certainly not going to champion it, I'm going to still revisit the idea that this is a very difficult day. But if I get stopped out, I still stop on the day, on the high. Like I have more than what this started with. And that's the takeaway. If you get something early on the day and then you try again to trade and it becomes really difficult for you to do, you have to identify that. And don't try to push it away like, well, that's just me being a wimp. I got to get out here and push my edge and push your edge. Well, I have an edge, but it's being dulled as every new candle creates. It's not finding its momentum higher or lower. It's not trying to move anywhere. So they're holding it The market's being held. And if I close the stream and it starts tearing off, that's not going to make me stop using what it is I used to trade with. It just means that, okay, I limited how much mental capital I'm willing to expend on this particular trading day. Because if you do something that you terribly draw your account down or you blow it, another stop out right there, it's something you're going to carry with you into your next trading day. It's going to carry you right into your next trading day or your next account. If you blow the account, you're going to go in with anger or fear, and it's going to cause you to have difficulty pressing the button. And that's real hard to overcome because once you get that scar tissue, it's there. And scar tissue is not flexible. It causes the inability of what would normally be allowed to move with tissue. Like if you ever, like I've been shot, I've been stabbed. In those areas, I can feel small little adhesions. And every time you hurt yourself trading, you're creating those adhesions. And they're attaching themselves to fear and anxiety or anger. And every single time you do that, you keep adding more scar tissue psychologically. And it makes it very, very difficult to trade outside of that once you acquire it. So you're always going to have losing trades. That's going to happen. You're going to have days that aren't going to pan out for you despite what you think you're trading with, whatever skill set or ability you have. You're going to be met with days where it just simply is not going to move. And you're at a crossroads. Do you submit to the fact that you're expecting the market to behave in a manner in which it's not willing to do on that day? Not that it will trade for you in your favor at another day, but at that time there has to be a threshold where you say, okay, I'm at a limit at which I'm willing to keep participating in this. And you have to push aside that fear of if you leave, if you stop trading for that day and it moves where you thought it was going to go, who cares? You didn't risk any more money. You didn't spend any more mental capital, but you take away from that with this. It moved where I thought it would move. And while I was not successful at the time executing on it, I did not lose any more. And I'm feeling very confident that where I thought the market was going to go, it went. Where I need to refine my skill set is the patience and waiting for the right setup or the trade frequency. I need to limit it, lower it. Because if you lower it, chances are you would take the trade, the last trade or whatever trade would be, later in the trading session. But because I want to be done by 11 o'clock, I forced myself into a corner where I had to push. And you're seeing, even in my hands, it's not trying to go anywhere. Let's go back to a 9:30 candle here. Okay, so here's 50% of the daily range from the opening bell at 9:30. So there's the high, there's the low, and there's halfway. See that? What have we done? Upper half, lower half, right in the middle. Okay, where's liquidity at? Right now, it's right below this low here and right there. And on the high end, it's right here and layered into these highs and this high. And you know what? It doesn't have to hit either one of them. It could stay right in the range it's created right here, and there's nothing you or I can do about that. There's going to be days where it does things just like that, and it's going to fly in the face of what you think is reasonable. It shouldn't do this. It should be doing that, or it should be doing this. Who says? You do. And you're not making the market. I'm not making the market. So you have to submit to the idea that, hey, it's not in the cards today. It's not in the cards, so therefore I have to excuse myself from the charts. Go do something else. And don't force your hardline opinion on what the market should do. And you'll find that after taking stop outs and you going through a period of drawdown, you're going to feel like you really want to smash this market. You want to take your revenge out on it. I have 1 million people follow me now. I am not embarrassed. I'm not phased by this at all because we outlined the fact that we were in the middle of the range. Whether the trade panned out or not, it made no sense to place so much emphasis on it. Was I confident enough that it was going to move so? No, because I went down to one contract. That's exactly how you do it. If you're in a position where you want to take a trade and you can afford to do more than one contract, whatever you can afford, okay, and you try to go to the upper end or at least more than half of whatever the maximum amount of contracts that you could trade with, and you're doing that in a market environment that you know you already are questioning the 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 profile that we're in. Now, I'm not talking about profile like you think the horizontal, vertical, or not horizontal, vertical, horizontal volume bars. Okay, I don't trade with volume profile. Okay, I don't use VWAP or any of those things. In this market environment here, everything's going to have a difficult footing. So when I see this, I think, okay, all this is doing is confirming that I need to push the brakes, stop, and wait for tomorrow. Not come back in the session later today. Not try to get a little bit of the hair of the dog that bit me. Just simply pump the brakes. There's nothing wrong with taking losing trades, especially if you've taken them and they're small. If the trades are small, what then? It's a paper cut. But if it is a measure of risk that's grossly out of normal, 5, 7, 10% of your account, or risking blowing the funded account if you're trading in those types of things, that's not good. That's not good risk management. And when you take a losing trade, or if you're a live streamer and you have a losing day or you take a losing trade, you feel, because I watch the live streamers, eventually they'll get into a trade and they say, oh, and they'll say audibly, oh, okay, no big deal, whatever. But their face is saying, oh, this hurts. And the only reason why it hurts is because you did it in front of other people. And I have thousands of people watching here today. And none of this has done anything to question how I trade, how I will trade, and what I think the market will do tomorrow, next week, or whatnot. Because losing trades are going to happen. You're gonna have to pay that toll. Everybody pays that toll. Nobody is exempt from it. But what happens is these times make you test your resolve. It'll force you to take inventory about who you are, what you're doing this for. If you're trying to just be right, you'll overtrade. If you're impulsive, you'll overtrade. If you're reckless, you'll do all those things and over leverage. So pre-session, I gave myself that trade to give me a little bit of a cushion, knowing going into this day, as I outlined throughout the live stream, that we are in a difficult day because we have traded to all-time highs, and then we had that initial run down into closing the gap. Okay, so for traders that usually trade the gap close, that's this here, by the way, in case I'm not making it clear to you what that is. We opened up here and we settled here the previous day. We traded down, closed the gap, overshot it, and now we're doing what? We're just hanging around inside that range. So this is very, very difficult to trade in. Anyone tells you it's easy, they're lying. And it's real hard to get a footing on that where the price runs will be sustained so you can get to a run that makes good sense risk-wise. Number one rule, preserve capital. If I know I'm in a day that is problematic, where it's likely to go into consolidations or seek and destroy, and this is not seek and destroy, by the way. This is just a simple consolidation day. It's just, it escapes me who I learned this from. Give me a second. This 50-year-old mind of mine. I'm having a senior moment here. They called it a Z day, and I like the expression of it. So it's kind of like that, where it's not really making a higher high, it's not making a lower low, it's just consolidating back and forth, and it's not really aggressively running for any particular pool of liquidity above or below. It just meanders sideways. Okay, that's what we're in right now, and this is the hardest market on a seek and destroy day. I can be profitable on that day, but if I stay with it all day long, eventually it'll burn me. These days like this is the hardest day for me because it starts off with, okay, it could be problematic, but then as the day goes forward, you start seeing setups that, okay, this looks like it might do this, and you go in there and you do it, and it just goes right back to the middle of the range and just keeps hugging it back to the middle of the range. It'll move a little bit and then come right back to the range. As soon as you start seeing that, your experience should kick in and say, okay, this is a day that doesn't have the highest degree of probability. This is a day where it might stay just like this the rest of the day. And the natural tendencies as a human being, especially someone now that wants to do this in trade with money, the natural impulse is to think, well, the move hasn't happened yet. And I know as soon as I turn off my charts, it's going to move and I'm going to miss it. And you're equating that as a punishment or a loss of opportunity, where I'm trying to convey the idea that, yeah, that might happen, but that's a trade that you're not risking any money on too. So that's a winning trade that you have the benefit of seeing if that does pan out with no risk, not even in a demo, not even in clout online because you called something. That doesn't have an effect on me. Earlier on, it did, and for you, um, some of you might be thinking, well, why did you take 3 stop outs today, ICT? I mean, you're supposed to be Mr. This and Mr. That. Well, I am Mr. This and that. Okay, give me the market that's going to move, and I'm going to show you. But going in, I outlined all this, saying that we're right in a time where it's a very difficult day, and I'm going to put myself out here in front of you in a very difficult day, and nobody can question whether or not this has not been a difficult day because it's just ranging around, it's consolidating, and you can't force it outside of its range. You can see a setup, and you can give all kinds of reasons as to why you think it's a good time to buy or sell. But if the market's not going to move, guess what that means? It's not going to move. And a neophyte, someone that is undisciplined, someone that is not versed in being responsible for their own actions, their own decisions, they will impulsively think to themselves, well, I have to keep doing it because I know the move is eventually going to happen and I'm going to get it. But what happens if you do that 12 to 15 more times? And they may be 200-point losses, or I'm sorry, $200 losses, and they're not that much in terms of money because you're trading with a funded account and it's not real money. But eventually those losses will take you to, and I don't remember what the maximum losses are for because I don't trade with those things, but whatever that maximum daily loss is, you'll get there eventually on a day just like this. Or if you do maximum contracts and you do that trade copying thing and you trade real hard on a day like this, well, you roast all of the accounts or however many you linked up. And that's demoralizing. Whereas I'm sitting in front of you with a really large audience and I'm completely content with this because this is what's going to happen for you. The rest of your career, you're going to be met with hard trading days and you got to make a decision. Do you really want to push hard in a day that's already proven to you that it's not doing anything? It won't budge, just like a stubborn mule. It just will not move. and assuming that your mule will start running for you or run into where you wanted it to go after you leave it, well, that's, to me, that's stupid. It's stupidity. You're insisting that you're right. You're going to be right. Given enough opportunity to prove it, eventually you'll be right. But how much are you willing to draw down in your account to eventually be able to say, see, I was right. I took 17 losing trades and I got it all back in covered commissions on my last trade. Winning. That doesn't equate to skill for me. It shouldn't equate to skill for you. But showing responsibility. I mean, look where we're at right here. I mean, look what it's doing. To me, that's indicative of go outside and get some air. Go do something else. Go read a book. Go spend time with your family or friends or take a drive. Because there's better days to trade. And because this day was not all that fruitful, I will try to make an allowance for tomorrow and see if I can find a couple hours tomorrow morning. I don't know if I'll go before 9:30, but I'll definitely try to be with you live tomorrow, about 9:15. Let's say that 9:15 Eastern Standard Time. Okay, so whatever local time is in New York City, New York, whatever that time is there, that's what you should have your clock at your home, wherever you're at in the world, and that's the same time ICT is looking at. Okay, so 9:15 tomorrow, I'll do another live stream, and I'll sit with you all, and we'll see if the market wants to provide anything tomorrow, and I'll push some buttons in front of you then too. But I covered a lot of things today that my own personal students requested I talk about, and a lot of other questions that came up a lot in the comment section. So when you have time, you might want to revisit the first half of the video because I talked a lot about things that seem to keep coming up a lot, and I maybe not done a good enough job discussing it when I was teaching it throughout the lectures. But it's a lot of content, it's a lot of coursework, and sometimes in certain lectures I do a better job of talking about something because I don't have a script and I go off of whatever I'm talking about at the time. And if I don't talk about the subject matter to your satisfaction, it may feel like I'm hiding it from you. I'm not hiding it from you. It's just there's so many other things that are happening in front of me in the time of recording it. If I'm looking at a chart, my attention goes to watching what it's doing, and I'm trying to read it all the time. So, but I believe this lecture that I did, the first half of it, I covered a lot of things that I don't know how I will be able to do it better than teaching how I trust certain fair value gaps over others. I won't know how to do another way of explaining runs on liquidity and how I know it shouldn't go beyond that. That's my answer. That's the final answer in that question. And I understand that it won't satisfy some of you because you're either too new at what it is I'm doing, or you're not familiar with it, or you're just not going to be satisfied in any case. So um, I'm trying to convey the idea that I did my best in answering the questions even my personal private students asked, and I don't have another way of explaining it except for experience and using the rules that I outlined in the first half of this one today. So my gut tells me to buy this inversion fair value gap. Come on, buddy, one more time. One more time. Come on. That's because I'm sitting in front of the charts. It's not because I want to try to save face because I already told you if I bought it and went up to hit those buy stops, it still doesn't change the fact that it's a hard day. But it is 11:04, and I'm going to close this one and just remind you that I will be willing to sit with you tomorrow live. It won't be so much of a teaching thing because I want to go in and focus on what price is doing. And if I get a price run and I'm able to participate in it, whenever that price run ends and whatever execution I make when it closes, I'll close the live stream then. I don't want to be in front of the charts. I don't want to do that, all day type thing like we did here today. But despite the 3 stop outs, again, the let's do the numbers here. There you go. This would be a $885.55 profitable day with 4 trades, 3 stop outs. Okay, so 3 stop outs, 1 winning trade, drawdown on the last 3, and the brakes are being pumped. Okay, so I still favor that 17,501. I like that buy side still. So if it runs up there, it's a moral victory. Yay! I was right about that, but I was wrong on every one of the executions after this morning's earliest trade. So that's it for this one. I will do what I can tomorrow. 9:15, I guess we'll start, and I'll see you then. Until I talk to you next time. Be safe.